The commercial real estate market is experiencing a significant inflection point in early 2026, and understanding what is happening requires looking beyond the headlines into the actual data that institutional investors, lenders, and regulators are studying closely. Over the past 3 years, we have witnessed the office sector face unprecedented structural challenges, and these challenges have now manifested into measurable financial stress that is impossible to ignore. The office-backed commercial mortgage-backed securities delinquency rate reached a record of 12.3% in January 2026, according to TREP data, surpassing the peak delinquency rates experienced during the 2008 financial crisis by 1.6 percentage points. This is not a theoretical problem or a distant risk. This is happening right now. The difference between this crisis and the financial crisis is instructive. In 2008, the problem was widespread across all property types. Today, the problem is highly concentrated in office properties, which represents both a constraint and an opportunity depending on your exposure and positioning. The national office vacancy rate reached 20.7% in the second quarter of 2025 and has remained elevated throughout the year. Multiple major office towers in Manhattan have defaulted or are in the process of foreclosure. One Worldwide Plaza, a 2.05 million square foot 49-story tower in Manhattan, had its collateral reappraised at $390 million in the fall of 2025, a 77% haircut from the 2017 appraisal of $1.7 billion. The property still carries $1.2 billion in debt, making refinancing under current market conditions mathematically impossible. A large Manhattan law firm vacated the space, and a global headquarters relocated, removing the tenants that had formed the foundation of the property's cash flow stability. These are not edge case examples. Across the country, large institutional landlords are facing a situation where their properties are generating insufficient cash flow to service debt while simultaneously being unable to refinance at terms that make economic sense. Some properties have been extended multiple times, but lenders are losing patience. The extend and pretend strategy that worked for several years is reaching its effective limit because the underlying fundamentals of office properties have not stabilized. The structural driver of this crisis is well understood: the permanent shift in work patterns following the pandemic. Companies that aggressively downsized their footprints during and after 2020 have not returned to their pre-pandemic office space utilization rates. Remote work policies, hybrid schedules, and the availability of high-quality vacant space have created a flight to quality dynamic where tenants move out of older buildings into newer, amenity-rich buildings when leases expire. This leaves older office stock with deteriorating occupancy, depressed rental rates, and insufficient cash flow to service debt borrowed when properties were valued much higher. However, the broader commercial real estate market is not experiencing a uniform crisis. This distinction is critical for anyone analyzing where opportunities and risks actually exist in the current environment. The multifamily sector, which includes apartment buildings and residential rental properties, continues to demonstrate resilience with historically strong demand driven by demographic shifts, affordability pressures pushing renters from ownership, and persistent housing supply constraints. The industrial sector, encompassing warehouses, distribution centers, and logistics facilities, continues to benefit from sustained e-commerce demand and global supply chain reconfiguration. Retail properties, excluding enclosed malls and declining shopping centers, show reasonable fundamentals in well-located properties, particularly in dense urban and suburban markets with strong demographics. The maturity wall that is often discussed in financial media is real, but the context matters significantly. Approximately $936 billion in commercial real estate loans are expected to mature or reach their extended maturity dates in 2026, according to revised S&P Global Market Intelligence estimates. This represents an increase of nearly 19% from the 2025 maturity wall. Many of these loans were originated between 2012 and 2019 when interest rates were much lower and property valuations were higher. The loans that can be refinanced are being refinanced at rates approaching 6.5% compared to the 2 and 3% rates at which many of the original loans were originated. This dramatic increase in borrowing costs means that many properties cannot support refinancing without either significant equity injections from sponsors or substantial reductions in asset values to reflect the lower income the properties can support under current market conditions. The commercial mortgage-backed securities market, which represents approximately 1/3 of commercial real estate debt nationally, has shown measurable stress. Yet paradoxically, CMBS issuance in 2025 reached $125.6 billion, up 21% from 2024 and approaching post-financial crisis record levels. This reflects the reality that while distressed assets exist and some borrowers are struggling, capital remains available for well underwritten deals. The issuance of new CMBS has increased because lenders have become significantly more selective and demanding. New deals are being originated at more realistic underwriting standards with higher equity requirements, more conservative loan-to-value ratios, and stricter cash flow covenants. Essentially, the cost of capital for investors has increased dramatically, but capital is not entirely unavailable. It is simply more expensive and more difficult to access for marginal deals. Commercial real estate investment activity is expected to increase by 16% in 2026 to $562 billion, according to CBRE research. This growth would come even as office properties face significant pressure. This apparent contradiction reflects the reality that sophisticated investors are aggressively acquiring distressed and undervalued properties in non-office segments, while also selectively deploying capital to acquire office buildings at substantial discounts to refinance them at new valuations and sponsor capital plans for conversion or repositioning. The opportunity set in commercial real estate in 2026 flows from understanding that this is not a macro crisis in commercial real estate broadly, but rather a sector-specific and often property-specific crisis in office. Multifamily properties in markets with strong population growth, limited new supply, and reasonable valuation metrics remain attractive. Industrial properties in logistics, dense markets with long-term triple-net leases backed by investment-grade tenants provide stable cash flows and inflation hedges. Retail properties anchored by essential retail uses in well-trafficked locations with strong demographics continue to function properly. Office properties, by contrast, offer the largest value destruction for investors who hold legacy positions and the largest opportunity for investors with capital and operational expertise who can acquire them at distressed prices and implement repositioning or conversion strategies. The conversion of office buildings into residential use represents an emerging major opportunity. Across the United States, approximately 24,735 apartment conversions have been completed or are in the pipeline, according to recent data, with office to residential conversions now accounting for nearly 42% of approximately 169,000 apartments in future adaptive reuse projects. Cities and states are increasingly providing tax incentives, expedited permitting, and financing support for office to residential conversion. San Francisco, New York, Seattle, and other major metropolitan areas have established specific programs to facilitate conversion of vacant or underutilized office buildings into residential units, acknowledging that the demand for office space has structurally declined while the demand for urban housing remains strong. Converting an office building to residential use is not a simple exercise. The conversion typically takes 25% longer and costs about 25% more than new construction on comparable square footage, according to architectural and engineering experts. Office buildings have large floor plates, column spacing, and mechanical systems designed for office use, not residential use. Converting them requires substantial structural modifications, new mechanical and electrical systems, greater number of plumbing fixtures, separation of units, means of egress modifications, and facade changes. However, when the acquisition cost of a vacant or under-rented office building has declined substantially, and when the market demand for rental housing is strong, the economics can work. Additionally, conversion projects in many jurisdictions are now eligible for historic rehabilitation tax credits, opportunity zone deferrals, and accelerated depreciation, which can significantly improve returns. For real estate investors attempting to navigate the 2026 environment, several practical implementation strategies emerge from analyzing current market conditions, capital availability, and regulatory frameworks. First, conduct rigorous sector analysis and avoid generalizing about the entire commercial real estate market. Distinguish between office, multifamily, industrial, and retail, and within each sector, understand the subsector dynamics. An A-class multifamily property in Dallas, with 95% occupancy and strong rent growth, presents an entirely different risk and return profile than a 1970s office tower in Detroit with 35% vacancy. Real estate is local, and real estate is also sectoral. Treating all commercial real estate as a unified asset class in 2026 is an error that can lead to catastrophic capital allocation decisions. Second, for investors with capital looking for opportunities, identify markets with strong demographic tailwinds, job growth, population inflows, and housing supply constraints. These tend to be mid-sized metropolitan areas in the South and Southwest, experiencing sustained migration from higher-cost coastal states. Austin, Nashville, Phoenix, and Charlotte have experienced decades of sustained population growth, strong job creation, and limited multifamily supply relative to demand. Markets with these characteristics tend to support higher rental rates, lower vacancy, and better debt service coverage ratios, which translates to lower risk for lenders and better returns for equity investors. Third, understand and utilize the tax frameworks available in 2026. The 1031 exchange, which allows investors to defer capital gains taxes by reinvesting sale proceeds into like-kind real property within specific time windows, remains fully intact in 2026. The Opportunity Zone program, which allows investors to defer taxes on gains from the original investment if they place capital into Opportunity Zone funds and hold the investment for at least 10 years, is reaching a critical date. Investors who have not yet deployed capital into Opportunity Zones but who have gains they want to defer should understand that the Opportunity Zone program faces potential changes and that 2026 and 2027 represent the final years in which current benefits are fully available. Additionally, bonus depreciation has been made permanent at 100% by recent congressional action, providing substantial annual tax shields for investors acquiring real estate assets. Fourth, for sponsors and developers working on distressed acquisitions or repositioning plays, deeply model the cost of capital and the timeline to stabilization. If you are acquiring an office building at 50% of replacement cost with the intention to convert portions to residential, what is the total development cost, including acquisition, construction, leasing, and carrying costs? What is the stabilized cap rate on the residential conversion component? What is the intermediate use and return on the office component during the conversion period? Does the deal work if interest rates remain at 6.5% or climb to 7.5%? What is your cost of capital, and what returns are you requiring to justify the risk? The most expensive deals are those where sponsors chase an investment thesis that seems to work on a spreadsheet, but where the actual cost of financing, the extended timeline, and inevitable cost overruns compress returns below the required hurdle rate. Fifth, maintain financial discipline and preserve dry powder. Investors who maintain substantial cash reserves during the 2023 and 2024 period are now in positions of significant power in the market. Properties are coming available at prices that would have been unthinkable 2 years ago, but only those with capital ready to deploy can take advantage. Markets are tightening, deals are coming, and the investors who can move quickly on well-underwritten opportunities will outperform those who are fully deployed and unable to act when exceptional acquisitions emerge. Sixth, model downside scenarios explicitly and do not assume that current market conditions represent a floor, property values can decline further, occupancy can deteriorate, interest rates can rise, market rents can compress. The best deals in difficult markets are those underwritten with the explicit assumption that performance will be weaker than consensus expectations. A deal that works if occupancy is 80%, rents decline by 5%, and interest rates rise to 8% is likely to work in reality. A deal that only works if occupancy stays at 95%, rents grow 3% per year, and rates stay flat is likely to disappoint. Seventh, focus on properties with strong underlying fundamentals, even if they face temporary weakness. Buildings with irreplaceable locations, strong demographics, trophy status, excellent infrastructure, or unique competitive advantages command investor attention and capital. A well-located multifamily property with a temporary occupancy dip and above-market rents can stabilize with a marketing push. A Class A office tower with below-market rents in a supply-constrained market can improve when markets normalize. Properties that lack these structural advantages, such as older commodity office buildings in declining secondary markets or retail properties in areas with significant competition from e-commerce, face more fundamental challenges that cannot be easily solved. The risk management framework that should apply in the current environment centers on debt structure, sponsor quality, and property characteristics. On debt structure, the most problematic scenarios emerge from loans with high leverage, floating rate exposure, balloons, minimal amortization, cross-collateralization across weak properties, and recourse to sponsors with limited assets. Conversely, conservatively underwritten loans with reasonable loan-to-value ratios, fixed rate terms extending through stabilization, meaningful amortization, and sponsor recourse provide stronger protection. On sponsor quality, institutional investors with long track records of operational success, the capital to inject if necessary, and the expertise to reposition or convert underperforming assets significantly outperform inexperienced sponsors with limited capital and minimal operational infrastructure. Realistic return expectations for commercial real estate in the current environment should be modeled with caution. Core plus stabilized multifamily properties in strong markets might be expected to generate annual returns of 8 to 11%, including appreciation, with lower risk but constrained upside. Value-add properties that require leasing, modest capital improvements, and operational optimization might be expected to generate 12 to 16% returns over a 5 to 7 year hold if execution is excellent. Distressed conversions or repositioning plays are higher risk and higher return, but require operational expertise and should only be undertaken by investors with the skills and capital to see them through. Stabilized industrial triple net properties with investment-grade tenants provide steady 6 to 8% returns with lower risk. Leverage amplifies returns in favorable scenarios, but also amplifies losses in adverse scenarios. A deal returning 12% on an unlevered basis, but financed 70% with debt at 7%, might return 18 to 20% to equity in a favorable scenario, but could generate losses to equity if property performance disappoints. The regulatory and legal environment for commercial real estate in 2026 includes several material considerations. Environmental compliance remains a focus, particularly for industrial properties where soil remediation, asbestos removal, and other environmental liabilities can be significant. Energy code compliance is increasingly mandated, particularly in states like California and New York, requiring retrofits to improve building efficiency and reduce carbon emissions. ADA compliance for accessibility, particularly in multifamily conversions, is non-negotiable and often requires significant capital expenditure. Zoning and land use regulations, particularly in adaptive reuse and conversion projects, vary dramatically by jurisdiction, but are increasingly favorable to conversion given the mismatch between office demand and residential demand. Wage and hour laws, which in some states require prevailing wage or union labor for construction, materially impact conversion economics and timeline. Looking forward, the commercial real estate market is not heading toward either a complete systemic breakdown or a complete return to normal. Instead, it is moving into a disaggregated market where office faces continued distress while other sectors stabilize. The probability that office property values will stabilize in 2026 and remain stable is moderate. The probability that some office properties will be converted to residential, hospitality, life sciences, or mixed use is very high. The probability that office sector distress will stabilize enough to prevent a second major wave of defaults in 2027 and 2028 is uncertain and depends significantly on interest rate movements, overall economic performance, and the speed with which corporate real estate strategies normalize. For investors, the key distinction is between macro trends that are largely uncontrollable and micro-level decisions that are entirely controllable. You cannot control whether office delinquencies decline or rise further. You can control whether you have adequate capital reserves to act when exceptional opportunities emerge. You cannot control overall interest rates. You can control the debt structure and leverage you employ on specific deals. You cannot control the broader economy. You can control whether your portfolio is diversified across sectors and geographies. You cannot control whether your local market experiences population growth. You can control whether you invest in markets with that characteristic. The commercial real estate time bomb that was discussed and feared in 2024 and 2025 has indeed detonated, but it has done so in a way that is more concentrated and sectoral than broadly systemic. Office property owners and lenders are experiencing real pain. Investors with capital and competence are finding exceptional opportunities. The next 12 to 24 months will be defined by significant capital reallocation from distressed office assets into well-capitalized multifamily, industrial, and selective retail investments, combined with a vigorous, adaptive reuse market converting excess office into residential. Those who understand this dynamic and position accordingly will benefit. Those who either panic and exit all real estate or who ignore the concentrated nature of the crisis and assume their property type is immune will struggle.